Hello everyone. In today's video, I will be talking about a strategy that you can take advantage of the NIO stock rise, and it's called a put sell option strategy. And I will walk you through some very simple steps that's intended for the beginners, but it can also be useful for others who already know it about how it could be useful for them, and at least they will get a perspective. So, and I am focusing this put sell option strategy. My basic intention is to get you familiar with this option strategy or this option tutorial with an example. And I hope because you have come to this channel, you already know about the NIO stocks pricing. So to get started, let's say on the 8/14th on Friday, the NIO stock closed at $13.10. Today is 16th, it's Sunday, and the market will open. We don't know where it will go. It can go up from 13.1 or go down from here to below. But what I'm trying to do is here is how I think about it. I know that the NIO has been rising for a while, more or less. Of course, it's more recently it's down a bit, but I missed the trend. I feel like that because just a few months ago the stock was trading under 6 and even lower, and I somehow missed the trend, and I missed by a wide margin. But somehow I want to go back and catch it this stock at $11. You have a possibility to do that, and or maybe $12. So what I do is you go to Yahoo finance.yahoo.com and click on the options tab, and in that options tab look at the drop down the dates. There are weekly dates like August 21st, August 28th, and in this particular example drop down the date that's August 28th, and then scroll down. On the top half is a call option. We are not talking about that. I had another video on buy call options. You can check that. Go to the lower half and scroll down the row that says $12 price. There are several prices: $12, $11, $10, $9, so on and so forth. Look at for the moment, look at the $12 put sell and look at the price. When I checked, it was showing that the price was 33 cents. And what does that mean? If I sell a $12 put, I get the money. Because you sell anything, you get the money. So when I sell the money, my account is credited with 33 cents. And everybody wants that money, so why not have that? The key question is what happens after that? Between now and 28th, the stock can go up and the stock can go down, and we will go through both the things, what is going to happen, especially around the $12 price. Let's say the price starts rising and it reaches $14 on August 28th, and it can happen because there could be some momentum. For example, people could be thinking that there is a new car sale data coming right after 28 in anticipation of higher vehicle car sale data volume. The stock price could be rising in anticipation of that, and $14 is not a very big price to cross, and it can cross. What happens if that price goes up to $14? Then you don't get any share. Your share is not exercised, your option is not exercised, you don't get any share, but you keep that 33 cents per share profit. And remember, in the options things, one option comprises of 100 shares, so you get $33 of that commission in your pocket. And if you look at it, it's a nice way to have that money in your pocket. You don't get any share allocated to you, you don't buy any share, you don't sell any share, you still get $33. And if you look at the percentage profit you make, so divide this $33 with $1,200. divided through, so the math is 33 divided by 12, and in terms of percentage this is like this. So this is about 2.24 and then 639 is 2.7%. You are getting 2.7% profit in 2 weeks. In just 2 weeks you get a profit of 2.7%. And why do I take $12 here? Because your broker company will set aside $12 as a kind of a escrow money, and we will come to that what in the case number 2 that will be a little bit of becomes clear to this. Now think about this 2 points, and even if it's like for simplicity keep it like 1% per week, then in 52 weeks if you keep doing this, refreshing it every 2 weeks, you end up making 52% profit over a year. Of course things will not always play out in your favor, and we'll come to that, but this is the kind of the profit we are looking at with the put sell options. Now let's come back to the case number 2 here, in which at the end of this two weeks period the price keeps going down, it hits $12 and it actually lands to $11, or maybe better, let's keep it like $11 and okay, let's keep it $11. So what happens? You are forced to buy the NIO stock. You are forced to buy, you have to buy, and that buy you will have to buy not at 11, but you will have to buy at $12. But you buy it at $12, but you are also credited with 33 cents of this commission. So your actually break-even price is 12 minus 33 cents, or 11.67. Now, so what is happening? How do you look at it? You look at it that if I would have bought this share at on 8/14, or maybe let's say on Monday it opens with $13.10, or on Friday you buy it at 13.10, you would have to purchase this stock at $13.10, and if the stock goes to $11, your loss would be $2.10. Now your loss is, because now you have a break-even price of $11.66, your loss is only 67 cents. I hope it's making sense to you and you are able to understand it. So I'll go back and see what my strategy is usually in such cases. What I try to do is, and both of them could be a good strategies, I usually do a put sell with the intention to not own the NIO stock. And when I do that, I keep this strike price substantially lower than the current price, because I don't want it to, I know it's most likely it's not going to go that low, and if it all I do is I just collect this 33 cents and I just make my 1% week or 2% per week of profit. That's it. And I keep doing it every 2 weeks, every 3 weeks. But once in a while, or in fact it has happened quite a bit, that the prices do drop substantially, significantly, maybe a negative news, maybe coronavirus, maybe the China and US fights, maybe some whole macroeconomic going down, the car sales are going down, maybe car subsidy is cut down by the Chinese government, or whatsoever bad news. The stock do drop down phenomenally, and so in that case I do get this stocks allocated for $11, and it keeps going down below that. My only respite in that is that I did buy the stock, but I purchased it at a price which is like 15% lower than the current price. And my expectation is that eventually the stock will further go up, and at some point of time I will make profit. So my strategy in the case that the stock drops down to 11, in that case I open another put sell. I say I have $100 stock which I purchased at a break even of 11.67. Now the price is $11. The 2 weeks from now I do another put sell. I sell another 100 put sell at a strike price of, let's say, $9, and from 11 it can go further down to 9 and keep going down. In that case I will get another NIO stock of break-even price maybe $8.9. That way I will average myself down, or it can start going up from here. In this case I make profit in two ways. I collect the commission from this $9 put sell, and I also make profit because it starts becoming close to my purchase price of the first 100 share. So this is the put sell strategy, where you try to catch the train of a stock which you could not buy at a lower price, and you know that it's going to rise in future. Now there is one case where you will feel like your strategy was not that good, and I will tell you about that also. Let's say right now the price is something like that here. This is the peak price it reached a few weeks ago to $16. Right now it's here, somewhere here at $13. Now the stock price starts going up significantly here and reaches to, let's say, $25 in next 3 to 4 months. And that can happen because it's going to release a number of the car sale data. It's a new car launch, EC6. It's November results, and so on and so forth. So somewhere around November it could reach very fast. You don't know about the market price. I think it's fairly priced, but the market sometimes behave much more volatility than we think about. Now at this point, let's say you collected a premium of 33 cents for like only at 1 to 2%, and then the stock price went up, and then you think that now it's no more a good option to put sell and try to catch it at like $15-16, and you don't do anything. Now if you could have purchased this stock just right away from the market for $13, you could have made, like, let's say going to 25, it's almost doubling. You make a 200% of profit. But instead you are just staying with the 33 cents profit. Now you may feel that I should have, when you reach here, you may feel that instead of doing a put sell, I should have just bought that stock. So this is the, if the stock prices moves up steeply, the put sell option is going to give you a less profit than required. But if the stock prices goes down or it stays same, this is the best scenario for collecting the premium. The commission and the premium word I'm actually using interchangeably. Let's say this is the stock price 13.10, and let's say its price stays exactly 13.10 all the time. Then every 2 weeks, or maybe every 4 weeks, or every 6 weeks, whichever gives you the highest percentage of weekly profit, you keep collecting those 33 cents here, 33 cents here, and then keep going down, keep going away, and then you collect the whole 52% over a period of time. Or if the stock increases a little bit, not much, but a little bit sideways, then also you keep collecting. Or the stock could keep going down, and every time it hits just above your strike price, about $12. If the stock stays a little above 12, for example 12.10, you still keep your premium of 33 cents. Then next week you can again make it at $11. If it's keeps going down in a slow fashion over the period, then also you can keep collecting your premium of 33 cents. So in put sell option, you make money by the premium when the stock goes up. You make money with premium when the stock stays same, and you also make money when the stock goes down by a slow. The rate of the decline is slow, just not hitting your target price, your strike price, something called strike price. In this put sell strategy, you act as a insurance company, and I had another video about this, the put sell put sell strategy, and I will have more videos about it if you subscribe this. So you act as a premium company, and looking at the other side, who is the person who is buying this put sell? The put sell buyers are those who are fearful of being stock getting hitting this rock bottom, maybe because of something corona like event, or something like any catastrophic event going down, making the stock go down quite a bit. So the put sell buyers are feeling that the stock would go down to maybe, like, let's say $3 or maybe $6. 3 is too low, but it could go down to like $7 or so. That is a possibility, because we feel that the stock is overpriced. And then, so put buyers, what they do is they are sitting here at 13.190 right now, and then they buy a put sell for $12. They pay a premium in a similar fashion that we pay the premium for our cars, premium for our homes. So what do? We pay a 33-cent premium to my insurance company, and what does that insurance company do? It provides a protection. If your car gets crashed, it pays you a premium. So this guy here, sitting with $13.10 on NIO stock, he feels that he wants to be protected if the stock goes much below $12, something like $7 and $8. His losses will be from $13 and between $7 will be like $6. Now, by paying a 33 cents premium, his stock is forced to be sold. He can sell this stock at $12, and when he sends that, his effective price is 12.33. Sorry, 11.67, and at 11 this is the net price that he will pay when he sells his stock. But because the stock can go down all the way to 7, he is saved from this bigger loss. He is saved from the prices he incurred when his car crashes, or when his home catches fire. So he is buying a premium. And when the earlier video, when I talked about these cases, we are actually the insurance company, and in the insurance company, I take the stock when its price went down, and my expectation is that I am an insurance company. The car got damaged, but it's only like a dent like damages. It rarely happens that the whole car got damaged. He sells the car to me. I take that car, gets a little bit of dent, and whatever required, a little bit of hit here and there, and I use that car to drive on my own. At some point of time, I can sell that car, maybe as a vintage car or something like that. So this is the idea why I like to be a put sell for the stock that I believe in, that I know about it. So once again, if these things are still not clear, what you could do is head to your brokerage account or go to finance.yahoo.com and go to the options tab or whatever sections of option sections, and look at the prices and look at their movement with time. Look at how the options price move in time and how it moves with the stock prices. And to understand it, I will give you another example and put you a question to understand how these stock options price move with the time and the value. Before I do that, I let's say instead of $12, I wanted to point out to you one thing. Instead of $12, I could also do an $11 put sell. And when I looked at my Yahoo Finance, the price was something like 11 cents. So in my case, or maybe 13 cents for simplicity, let's keep it 13 cents. So if I now I need to check if do I want to do a put sell at $11 or do I sell put at $12? Or maybe even $13. There are $13 put sell as well. The price may be like 50 cents or maybe 60 cents. I will have to check on my laptop. I can do that, but that's not important. If I do a $11 put sell, you need to guess, you should be able to guess whether the premium is going to be less than 33 cents or more than 33 cents. So think about it like this. I want to be able to, as a seller, as a put seller, I want to be able to buy that stock at a lower price. Obviously, I will get a much less price if that strike price does not hit. So the lower the price you go, the lower is the premium for that. And then let's say if I do not want to own that share, then I should opt for a strike price that is much lower than the current price of that stock. But if I do want to own that share, I desperately want to own that share at a lower price, I would prefer to do it for $12. If my faith in that company is very high, I desperately want to own that share, and maybe even $13, because then I will own, there's a very good chance that it will strike the $13 at some point of time in the next 2 weeks, and then I get this stock at a lower price or much lower price than 30, maybe like my price would be 12.5 instead of 13.10. So this is how you are going to select your strike price, depending upon whether you want to own the stock at a lower price or you do not want at all to own that price. So coming back to understanding how the stock is the put sell price move in time and with the stock price, let's assume another example. And I looked at the November. I can move my date, the put sell date from August 28th. It's actually a weekly, then for 2 months, then it turns to monthly, and then it goes to yearly. So let's select the November 20th, which is Friday. Every Friday, those strike dates are only move weekly. On November 20th, the put sell. Let's select the price of $11 of put sell, and when I looked at that, it had a price of $1.66. So what does that mean? Between now, August, September, October, November, 3 months, you have a $1.66. What it means that your brokerage account will set aside $11 from your account, and this is very important to know, and that's what I was going to tell. I missed that point earlier. The brokerage account will block $1,100. You cannot do anything. You cannot touch it. It is in that escrow account. Now for that and let's say the stock keep rising and stays above $11, then at the end of this strike price on November 28th, you will be paid $1.66 for each share, or for $100 it will be $166. But brokerage account had set aside $1,100, so your profit could be close to 1 and then 5, 6, 15% in 3 months. And this is about this is 5% per month, or if you can say 60% per year. And this is a good price to have. So now the question I was going to that, it's not necessary to wait all the way until November 20th. You sold the put, you could buy this put back. And to understand this concept, and that's where beginners struggle to understand, is that they think that they need to wait all the way until the exercise date to take a profit. But that's not true. And for this, to understand this, I have put up the question: what will be the put sell option price on October 15th if the price stays at $13.10? I'll take the question number 2 first. What will be the put sell option price? Right now, today is 8:14. On August 21st, the stock price suddenly shoots up to, let's say, to make it a more extreme, I would say it shoots up to $20. Some very good news came up very early, and something phenomenal happened. Some more investors came in, some big money market came in, they poured a lot of money, bought all the stocks into it, and the stock price shoots up to $20. Now, when the stock price shoots to $20 right on the August 21st, the chances of going it down to $11 becomes very bleak. There's absolutely zero, almost zero chance that it's going to further go down from $20 to back to $11 in the remaining period of time. So the put sell price is going to go down. Instead of $1.66, the price may go down to only like 33 cents or maybe 20 cents. I hope you are following it. If not, you can try to follow the movement of the price of the option. This 33 cents is not a fixed number. It changes every day, every minute. It changes less frequently than the stock price, but it does change. It does not change every second, but it does change every half an hour or so. It's a changing price, and you could trade on that changing price. If the price of the stock goes up, the price of the put option, it decreases. Now we say we sold this option at 1.66. If the stock suddenly goes up, the stock price goes down to 20 cents, you can buy that option back. Put sell option, you buy that price. And what you do, you sold it for 133, you buy it back at $20, you make a profit of $113. So this is the mindset. You start with some concept, some strategy. As you start watching the price movement, you start becoming mature, and you play. You don't have to exercise the stock price all the way to its end. You can just sell the option and then buy back if there is a sudden change in the price moving upward. And then you set up a different strike price, a different strike. You start the game all over again. That brings me to the second question of the time movement of the stock options. What will be the put sell option price, say on October 15, if the price stays at $13.10? Think about it. Maybe pause this video and critically analyze this thing. Right now, the insurance is for a big time, 3 months of time, $1.66, more than 3 months of time. Now the time has reduced to barely between October 15 and November 20, only a month is left. So why would someone pay that much of premium? It's already $13.10. The chances has reduced that something catastrophic will happen in that smaller period of time. So he will be willing to pay less premium. So as the time goes, if the stock price stays constant, hard to draw something in the time and price both, But as the time goes by, this is time, and let's say the stock, this is the put option price, and let's say the price is fixed, the stock price is constant, then the price of the option, which was initially $1.66, it keeps going down. So I am betting that I sell my put, and I think that I see no reason why the price should go up or down. It should stay constant. Then the price of that put sell starts going down, and at some point of time I buy this one and take the profit. I know it's going to look a little weird and it's hard, but the only other way I would suggest it's going to be very hard to follow everything I said, and I don't claim that I am able to explain everything, because it takes time. It's a time, unless you watch this, unless you do your own practice, and the only way you want to do is now go back to your option trading brokerage account, or at the minimum you can do is go to Yahoo Finance, click on option tab, look at the price today, look at the put sell option price right now, and then follow it right on the Monday morning, and then watch its movement in time domain, watch its movement with respect to price, because the number of variables are more. It takes time to get a feeling of it, but I hope that eventually it will help you. Thanks for taking a look.